Well, good afternoon, everyone. After being virtual in all my meetings, I think I've forgotten how to do a presentation live. I'm delighted to be here. Ned was my professor a long, long time ago. And this is actually very true. For a long time, we were the first class that took written field exams, and Ned was, the lead person in the macro. And I had the classic recurring dreams that I would get to the exam late, or that, that I forget it. So I had those nightmares for a long time. Nothing to do with you, Ned, but, So, we've heard about a variety of problems today, with ranging from threats to democracy, from Ned's comments on the dissatisfaction with work and life. I'm going to talk about yet another problem, which is, I think, one that is a fairly recent vintage, and it is a problem, I think, that we're going to be facing going forward on the development side. It's really a development problem, and it's multifaceted. I am going to describe it. I called it the reversal problem. And the reversal problem, just to give you a background, and I'll define what the reversal problem is, but I am on public service leave from Harvard, at the World Bank, and colleagues around me are, very different. I'm a macro finance person, and, there are people doing health, education, infrastructure, and listening to all of them talk about what they're seeing on the ground in terms of the aftermath, and we're not really at the aftermath stage of COVID. What we're really seeing is a collective setback on many fronts, and that's what I'm going to be talking about. So let me start with the shock itself. This is to state the obvious, right? What you see here is per capita GDP, the share of countries that had a decline in per capita GDP that year. In 2020, 90% of the 196 countries that the IMF tracks had an output decline. I would note that surpasses World War I, the Great Depression, World War II, and the debt crisis of the 1980s in developing countries. And this really sets the stage for the kind of big hit, big shock, and its lasting consequences. What I'm really here to talk about is the lasting consequences. Furthermore, I'm sure all of us reading the financial press have heard a great deal that the COVID-19 shock is a very regressive shock. And it is regressive within countries, affecting the most vulnerable in societies, but it's also incredibly regressive across countries, and that's the evidence that I'd like to leave you with. And this is what I call a reversal problem that will be a development challenge for, I think, some time. So let me say that I have a more benign view. I take it, in this morning we heard that globalization had delivered very little, that it had delivered greater inequality, job losses, dissatisfaction, and that's all true, especially in the affected industries, and especially in the advanced economies, in the wealthier economies. Now, even I think critics of globalization do point to a rather benign trend in the first 2 decades of the 21st century. There was, steady progress on poverty reduction. There was a narrowing, a convergence between high-income and low-income countries' GDP, and a much lower incidence of financial crises, be it debt crises, inflation, growth collapses, all of those were less prevalent in the last couple of decades. And, you know, this also allowed a lot of the poor nations especially to devote more to progress in other areas, you know, including education, including gender equality and such. Now, I'm not going to blame everything on COVID. There were a lot of emerging problems before COVID. But the fact is that the COVID shock, and I hope the first chart, which spans 120 years, gave you, you know, a good feel of how big it was by any historic metric and international metric. There are big setbacks, and that's what I am going to try to convince you of, that we have a real development challenge, a big setback to work against. What this table shows in the top panel is what share of countries had a true recovery. Now, what do I mean by recovery? A recovery means you're at least on a per capita income basis as well as you were before the crisis. If not, it's obviously, you know, a rebound, not a recovery. And countries have had rebounds of varying degrees, but what this table shows is that in the advanced economies, about 41% of the countries have higher per capita incomes in 2021 that they did in 2019, before COVID. When you go to the low-income country group, it's only 23%. Very unequal shock, very unequal recovery, very unequal rebound. Worst yet, many of the countries, especially the low-income countries, already had serious problems ahead of COVID. And that is reflected in the bottom panel. And you see that if you look and ask the question, is 2021 a peak in per capita income? Only 11.5% of countries, it's a peak, which means that when you're talking about very low levels of income per capita, you can only imagine, and I will briefly highlight that, what this is doing to global poverty rates. Global poverty rates increased in 2020 for the first time since 1998. Now, I'm not going to go through all of these in detail, but suffice it to say that very large fiscal deficits have emerged globally. Financing needs are huge, especially in developing countries. And this doesn't even take into account the amounts of financing needed for transitioning to green finance. This is financing needs because of collapses in revenues and, of course, the need to provide emergency assistance. So this, again, this doesn't even flag the issue that additional finance will be needed to provide a transition, adaptation, and the like. Now, one of the things I said that had been relatively benign was that not that many countries had had debt crises or inflation crises. That is changing. This just highlights, this is the level of debt relative to GDP. It highlights, for developing countries, it's much, much lower than for advanced economies. But it highlights that they're already at a very vulnerable stage. This is not a hypothetical. If you look at the 73 low-income countries that are eligible for the debt service suspension initiative. This is the G20 initiative that temporarily suspended these low-income countries to having to repay their debt. during COVID. More than half of those countries are already in debt distress or at high risk of debt distress. This is really important. It's important because another take of it is, well, so what does it mean to be in debt distress? It means that you're allocating more and more resources towards debt servicing. It means that you may not be able to borrow, which means that all these setbacks to education, to health, to infrastructure, to every dimension, social and economic, will be very difficult to address. You know, people say, well, you hear, look, debt levels are high, but at these low interest rates, debt servicing is low. That's an advanced economy story. That's not an emerging market story, and this is what this is showing here. This is the level of debt service, total debt service, relative to exports. And the reason we look at exports here is because, unlike advanced economies, middle and low-income countries have a lot of debt in dollars, in foreign currency. And so they need to earn dollars to be able to repay their debts. And that's an increasingly complicated scenario. Furthermore, as we hear from, you know, all one has to do is type the word inflation in Google, and what one sees is the number of searches skyrocket recently. Well, inflation, and here what the panel, you see the advanced economies and then the emerging markets. About 65, almost 65% of developing countries have inflation rates above 5%. And you may say, well, so what? I mean, is there anything magic about 2%, 3%, or about 5%? The problem is that the inflation story is also incredibly regressive. This goes back to my earlier comment that COVID is an especially regressive crisis. Inflation is too. It's often associated with outsized inflation rates in food prices. And what you've seen in the last year and a half is the issue of food insecurity rising disproportionately more than the overall inflation rate. So inflation is a tax. It's a tax that nobody votes for. It's a tax imposed by non-elected officials. It's a tax from the central bank. But it's an especially regressive tax. And remember, food and energy are a big basket among the low income. Poverty rates. If you think that I'm giving you a depressing talk, I am. But, you know, this is what I also listen to on a daily basis as the reports come in. Poverty rates, it asks the same question. You remember the chart I showed on per capita GDP and asked the question whether 21 was better or worse than 2019. Well, this is what it's doing here with poverty rates. The first line is, are poverty rates in 2021 greater than in 2019, pre-COVID? And the overwhelming numbers you can see there by region, especially for sub-Saharan Africa, in 78% of the countries, this is how you read this table, in 78% of the countries, poverty increased in sub-Saharan Africa. Overall, for the world as a whole, in 70% of the countries, poverty has increased post-COVID. And you know, this is why I call it the reversal problem. This is not a setback. You know, there's an asymmetry. The decline in poverty is slow, but the spike is sharp and swift. In other words, it's easier to destroy than it is to build. Widening inequality within countries is also been an issue. I'm rushing here because I wanted to give you the big panorama, and I will also say a couple of words about what I left out. But again, the regressive nature of the shock is not just across countries, it's not comparing the high, middle income, and low income countries, it's also within countries. The lowest, and the new poor are mostly women in urban areas, because the prototype poor is rural, farmer, no particular gender bias there, roughly men and women, equally poor. But the new poor, the marginal, the incremental ones post-COVID are mostly women with children in urban centers. The road back is a long one. Basically, what the poorest 40% have not even started to recover income losses. And finally, this is the last chart that I'm showing, but I wanted to give you a big picture. I didn't put anything on health or infrastructure, but this is on education, since we are at a university. So the World Bank does have what is called the Human Capital Index, which measures among other things, the education and productivity potential of the labor force. And learning was more severely affected by COVID in developing countries. That is, closures were more erratic, longer. The return of students has taken longer, and the return of girls especially has been particularly delayed. So, I don't want to leave you utterly depressed, but I did want to make a compelling point that very often when we read the headlines about overheating, about the labor market going back to pre-crisis levels, that's very much a U.S. experience. U.S. had the firepower on the monetary and fiscal side to offset much of the effects of COVID, but that is not really representative of what we're seeing in middle and low-income countries around the world. Let me stop there. As I said, I would probably bore you to tears, but this is a lot deeper. I just gave you sort of a snapshot, if you will, of the reversal problem.
And we can do some questions, I think.
Sure.
Hello, Carmen. I am from Mexico. My name is Alfredo Navarrete. And Mexico was kind of an exception last year because Mexico's government didn't have like a counter-cyclical policy. So basically, they kept very reduced fiscal deficit. They didn't increase the public debt, and they didn't have any support for the people in the COVID crisis. However, poverty increased also, and what is happening now to Mexico is that it's experiencing inflation. Have you studied a little bit of what happened to Mexico? That is one question. And the second question is that in your slide number 9, all the regions increased poverty except Asia. What happened in Asia? Thank you.
Okay. The Asia question is, I think you saw importantly also in a slide earlier, poverty rates in China continue also to decline. So if you look at, remember I said 90% of the countries had output declines. Well, among the 10% that didn't is China. We also, to be in the, and you know, in the spirit of frankness, we also have, we think we're maybe undermeasuring the poverty in India because the household survey used is older than what some of the household surveys for some of the other countries. So those are two, you know, but Mexico. What concerns me about Mexico, well, look, what you said connects exactly to what I've been saying. Part of the reason, a big part of the reason why poverty increased, why most of the social indicators deteriorated is precisely, and I know Mexico was there on the tail end by Latin American standards, but because governments didn't do very much on the fiscal front and on the monetary policy front to offset the effects of COVID. So that is along, you know, very much along the line, illustrating among the reasons I mentioned. The food price issue is hitting Latin America, including Mexico, very hard. Even more hit than Mexico is Brazil, where, you know, you're talking about, in many products, high double digits of price increases, which, of course, if anyone looks at what, you know, how a consumption basket is allocated, the poorer you are, the larger the share of food, the larger basically it's your basket reflects something closer to subsistence consumption. One other thing that I wanted to mention about Mexico is, and this is, you know, Mexico, of course, you know, has a chronic differential between North and South in terms of inequality. And what credit support there has been by banks, you know, to firms, it has been reinforcing that big north-south divide. So the issue of inequality is while the new poor are, as I said, concentrated in large urban areas, the old divide has gotten worse.
So, thanks. That's obviously very, very alarming in your presentation. I wondered what the balance was between the short-term or 1 or 2 year impact and what you saw in the medium term. Because if you think of the 1970s analogy, you know, I think you convincingly had many of the elements of the 1970s. The 1970s were about oil prices, but also about food prices, about high debt levels, about high inflation levels. But what the 1970s did in the longer run perspective was to push a kind of global opening. Do you see any kind of analogy if you look beyond the short-term impact of the next 2 years or so, when the problems are really terrifying?
Yeah, I mean, James, this is an excellent question and one that I think about a great deal. And here I will invoke Roman's distinction. I mean, the COVID shock was close to a Knightian uncertainty case because you've had pandemics before, the 1918 one, but you couldn't really construct any forecasting capacity from that episode. It was in the midst of World War I, for starters. So there was no large-scale shutdowns. But where you can start, James, looking at patterns is, given that output has declined so much and has stayed down, that inflation is worsened, that debt levels are high, that debt service burdens have gotten bigger. Are we in for another wave? You know, the 1970s, I'm gonna talk about the 1970s just very briefly on two dimensions. One is, before Paul Volcker in October 1979 put his foot on the brake and hiked US interest rates to historic highs, what you had was a very big boom in lending by US commercial banks, mostly to Latin America, but not exclusively. So they were, again, debt-laden, very vulnerable, and then the interest rate hike materialized, and you had a famous wave of defaults beginning with Mexico in August of 1982. Look, I'm not suggesting such melodrama for now, because it has to be remembered that by the time Paul Volcker put his foot on the brake, US inflation was also 14%. And it had been quite persistent already. Now, I am saying, and this is why I mentioned that even with more modest increases in international interest rates that are likely to come about, even if central banks drag their feet in responding, but are likely to come about as inflation, if inflation indeed is more persistent, which I expect it to be. In that scenario, what you have is this continual build-up, James, in the incidence of countries in crises, which, as I said, among the low-income countries, because they were already starting from a much weaker position even before COVID, you would see, a resurgence, perhaps not with the drama of the early 80s, but really hitting quite a number of countries. They're just countries that are not typically in the headlines. Let me also say that the dark side of that, I've studied, debt restructurings historically in quite lengthy detail. They take a long time. External debt restructurings, the agreements between creditors and debtors, on average, a debt restructuring episode takes 7 years. That's not encouraging. Hence, the recurring fear is this another lost decade, as the 1980s was for many developing countries?
It was a fabulous talk. I'm curious if you've been exploring how countries handled COVID and how that moderates some of these declines or rebound. Because clearly, countries varied in how much they botched this up. And I'm curious, including like New Zealand, like where would they fall on their swift response and debt and poverty? And then my second question is, I'm just curious about your experience being an economist coming from academia and going to the World Bank and how that's kind of changed your view of economics.
Okay, on the first one, I have to say that was our lunchtime conversation, precisely. And look, I don't want to be, I think we will learn. It's, first of all, too premature, because this is ongoing. I mean, Russia is at a new peak in COVID deaths and the incidence of new cases, okay? As is other parts of the, nearby area. There's huge differences in how deaths are recorded and huge differences in reporting. One, during our lunchtime conversation, I said, a friend of mine just returned from Tanzania, where his family, he hadn't seen his family in a couple of years since pre-COVID. He had intended to go, and the town in which they live in had entirely had COVID. Yet if you look at the numbers from Tanzania, they don't jump out as a high incidence case. What I'm saying is that the data reliability issue is a serious one. One area on the positive side, one area that we're looking into, the next World Development Report, is closer to my area of finance, which is, apart from monetary and fiscal policy, there's been a huge stimulus provided by financial sector policies, basically banks giving forbearance to their customers So businesses and households are not repaying their loans. Now, the question of how that has played out and how the withdrawal of that will play out is one area that we're evaluating, but we're also seeing increased risks of, underreported hidden loans, for example. On the second question, this is not my first job out of academia. I started in Wall Street, and I had been a couple of times at the IMF. Now, the IMF is very different from the World Bank. The IMF is more populated by people like me, macro, finance, World Bank is very diverse because of their mandate. You have two institutions with very different mandates. So it's been a real learning opportunity in other areas, especially on the social dimension. So, the one thing I despise is the number of meetings. It's endless. I'm not exaggerating, actually. Relative to academia,
Okay, do one last question here.
Hi, I'm Nathan Son, second year MBA student at Columbia Business School. And my question is, if emerging countries have a harder time recovering from the crisis compared to the advanced economy, and if it is the case that emerging market suffered as much as, if not worse, than the advanced economies, in perspective of avaricious investors, to my understanding, it could be reasonable to take a long position in the advanced economy market and a short position in the emerging markets, so that will provide me with a reasonable hedge and profitable returns. That was my thought. But if this kind of activity goes on, it will obviously deteriorate this kind of divergence and inequality. But I was wondering if you think there's a necessity of regulating this kind of investing activities?
So look, investors investing in the emerging market class, emerging market bonds, trade very closely to high yield corporates. Okay, they're high risk, and the regulatory dimension so far hasn't come from the international centers. So there is no initiative to regulate the EM asset class. Where you have had regulations is from the receiving country side, countries that are worried that they're getting, for example, too much hot money, okay? So things like transactions taxes, to reduce round tripping, go in quickly, get out quickly, that have been adopted, but largely on the receiving end. But if your question is, is this yet another profit opportunity in emerging markets, I can always say good luck. Because, the real question always boils down to, even when you're very convinced that the situation, this is not a sustainable case, this is going to blow up, but timing is everything. I was convinced Lebanon was going to have a crisis many years ago. It took a lot longer, but timing is everything. Look, yes, absolutely. All of capital markets tend to be pro-cyclical, okay? When things go bad, risk premia go up. You see it in the credit ratings. Credit ratings have deteriorated markedly for emerging markets, and capital flows out. It's pro-cyclical. I've actually written quite a bit on that.
Okay, thank you very much.